Our Aspen project, one, it's large, it's high quality. We have developed over the last decade or so proprietary technology that'll improve both the economic and environmental aspects of the project. It's very similar to our 40 years experience at Cold Lake. And so we put all that together. We think we have the right technology, the right time to execute what we believe will be a long life, high quality project.
So this thing, you hope, will run for 3 decades, 30 years. That's the beauty of the oil sands, of course. You have these long life expectations. Can you give us an idea, and there's a lot of variables, but what kind of a WTI price would you need to make Aspen profitable over that 30 years?
We look at our projects over a wide range of prices, but generally what we look for is we want to be sure we're globally competitive for capital investment. And for us, that would mean delivering a double-digit return in a $40 a barrel oil world. And it's the technology that allows us to lower that break-even cost and achieve an economic outlook that is better than most any oil sands project.
So even at $40 WTI, Aspen works?
That's our assessment. Now that depends on a lot of other things, differentials, market access and things, but our assessment is we want to be resilient in a low price world because of the inevitable swings we see in commodity prices.
It's a SAGD project. We know Imperial Oil, obviously better for mining. I mean, but you have got experience in steam assisted.
We do. In fact, I would say in the oil sands, our experience started with in situ projects with our Cold Lake operation that goes back some 40 years. So our experience in SAGD related projects, drilling wells, operating steam plants is quite high.
In terms of pushback, CIBC started covering the company last month, and they said, Aspen, the economics look compelling, but they had 2 reservations. For one, they said, we question whether it's going to be even clear whether this egress problem will be solved in years to come. Have you been getting any comments like that from big investors?
We produce about 400,000 barrels a day of diluted bitumen. We run some of that in our own refineries. We have contract commitments to get some of it to the U.S. Gulf Coast. We have a rail terminal that gives us a great deal of flexibility. And then the rest of what's remaining, we sell at the discounted prices in Edmonton. So as we look forward 3.5 years from now, which would be about the time it takes to execute the project, we hope that additional pipelines will come in place. We don't plan a business based on hope, so we'll look at our own refineries or either additional space in existing pipe or expansions of our rail terminal to ensure we get this to market.
I do want to talk more about your refineries. This is fascinating, but just one other factor that CIBC raised, your Nabier project in situ at Cold Lake. That one had teething troubles, and CIBC said, we're concerned that could crop up again with Aspen.
Yeah, Nabier was intended to be about a 40,000 barrel a day operation. We're about 25,000 barrels a day today, so we're under the design capacity. But more than anything, we look and we optimize our Cold Lake asset across the asset. So Nabier underperformed. It generally means we have steam available for other parts of the field that can then compensate and make up for it. So the kind of challenges we've had at Nabier are not atypical in the oil sands. And what we will encounter at Aspen, we expect to be quite different.
And we should note, Carl, you delighted investors in the latest quarter with that big mining project.
We did. We've had some teething pains there. Of course, we have a lesser experience base in the mining, but we've been ramping it up. And I'm really pleased with what we have done. And I think it's a good indicator of what we can expect going forward.
Could we talk about your refineries? Because you were at pains to note in the latest quarterly report, I refine a lot of light oil, and the current discount actually does improve my economics.
Right. We're fundamentally a heavy oil producer and a light oil refiner. So when you have an expanding light oil discounts, that's a benefit for the feedstock cost for our refineries. So we've designed our company to be balanced and integrated. And so there are natural kind of offsets that come when prices go up, prices go down, spreads widen, spreads lessen. But in a widening light crude differential, our refineries were a net beneficiary in that world.
And what about the widening heavy differential? I mean, you do use the heavy in your refineries, but you also produce a lot of the stuff.
We do. We produce more than we refine, and that's why it's so important to get access to the highest valued markets, which in today's world, that is the U.S. Gulf Coast. So whether that's pipe or whether that's rail, it's the largest concentration of heavy oil processing facilities in the world. That's where every heavy oil producer wants to get.
Talk to us just about crude by rail. Are you investing heavily in that?
Yeah, it was literally 5 years ago now that as we looked at our growth plans and we looked at the uncertainty in the industries, we took out what we referred to as an insurance policy by investing in a rail terminal adjacent to our Edmonton refinery. At the point in time, we weren't sure if we would use it like any good insurance policy, but if you need it, you're glad you have it. Yeah. Today, I'm glad we took out that insurance policy. We're using it at about half of its capacity today, about 100,000 barrels a day, and our plans in the coming quarters are to ramp up to more fully utilize that facility, again, to get to the higher valued Gulf Coast market.
So about a quarter of your production is going on that crude by rail right
yes.
now. And how much did you spend roughly as an insurance policy, would you say?
A rail terminal is fairly cheap in the grand scheme of developing in situ oil sands projects because it's some tracks and some loading arms.
Right.
So it is on the order of a few $100 million versus the projects are multi-billion-dollar projects. So as I said, the best way I can describe it is an insurance policy that I'm very glad we have.
And just to remind us, you have your approvals by Alberta. You've signed deals with the indigenous local communities, and that said, well, Alberta said, we're fine, we don't need a full assessment. And you don't, in this case, need a federal approval.
No, for in situ projects, they're the purview of the province. The approval was a long time in coming. We submitted an application nearly 5 years ago. Last week, we received that approval. We reviewed the conditions, we're satisfied with them, and we announced last night that we will be proceeding with the $2.6 billion Aspen project.
You did, during the process, express some frustration with the slowness of the whole thing.
You noticed that.
I guess, obviously, you want to be pumping the oil, and the regulation system is so complex.
Well, I think it's complexity, but we're also bringing new technology, and that technology will allow the oil sands to be more competitive economically. It also significantly reduces the greenhouse gas intensity, the water use. So giving the regulator some acknowledgement, we were bringing something new to the table, something we've developed over the last decade or so. So I think now that we have the project through approval, I think we're all going to be very pleased with the project as we go forward.
And just to wrap us up, can you, if possible, boil it down? You're using a solvent as well as steam to move this bitumen. What kind of solvent, what does that involve?
Fundamentally, it's a light hydrocarbon, and the whole goal is when you put energy into the ground to liberate more bitumen, to lower its viscosity, to allow more of it to flow to the surface. We and others have experimented with steam, adding, it's like a cocktail, getting it to just the right mix. So adding that solvent liberates more bitumen. You need less steam, hence less energy, less greenhouse gas emissions, and that to me is the winning formula.